invite you to ask questions. So we start now. All fine already? Excellent. So good morning to this first virtual guest lecture today on the 20th of April as part of our module Entrepreneurship, Entrepreneurial Finance and Venture Capital at Regent University. I'm delighted to have Ed Rios today as our guest lecturer. He was actually scheduled to come into class a few weeks ago, and then the coronavirus hit us and we had to postpone it. And now what we have is we have now the opportunity to benefit from his experience and insight and wisdom in a virtual guest lecture / interview with questions that you can ask a little bit later. I would ask you to stay muted until later when I invite you to ask questions. Ed Rios is an extremely interesting guest lecturer for us. He has been a commercial banker for many, many years. He will talk about that, in particular some experience in microfinance, but also commercial banking in general. He's also an entrepreneur and an angel investor, so he's going to talk about angel investment. And very interestingly, he's been associated with Regent University and Webster University, where we had an association with over the last 12, 13 years. He was a student of mine already when both of us were much younger. He was a student of mine in an MBA program that Regents ran together with Webster University of the US. And so we've known each other for 12, 13 years. He is American from Texas, but he's forth and back to the UK. He loves the UK. He comes forth and back. He's back to the UK now here. He is going to talk about his experience as a commercial banker, as an entrepreneur, and also with regards to his ongoing association with Regent University as a mentor. And he's also currently interested in a PhD program, doing a PhD on areas of finance, in particular microfinance, if I remember correctly, that he's interested in pursuing. So over to you, Ed. If you could just kick off and just tell us about yourself, and then about perhaps the markets, about the coronavirus, and then about angel investing. So I pass on to you. Thank you.
Thank you, Jacob, and good morning to everybody that we're talking to this morning. So I heard you say that this is the first video conference interview that we've done, so it's kind of nice to be first at something. The other thing is you actually got me to put on a collared shirt. I don't think I've worn a collared shirt in probably the last, I don't know, about 8 weeks. So I think you're having to do that a little bit more than I am, so it's kind of a first in a while, but kind of nice. I don't know, maybe I should have worn a blazer. But, you know, I was thinking about the things I was going to talk about today, and I think one of the moments in time that we probably need to reflect on a little bit is, you know, about the time I was doing my master's program at Regents, which was now, gosh, 12 years ago. Ironically enough, we were in the midst of something. That was 2008, 2009, and that was right after the financial crisis. And I remember, and I'm sure you remember quite well, things were changing very rapidly. The information that we were getting wasn't necessarily as up to date or accurate, right? And the volatility in the markets, the volatility in the business sector was unnerving, quite frankly. And it's not too different from some of the things that we're experiencing right now, although this situation obviously has a much greater health impact, and but like the crisis of '08 is going to have some incredible knock-on effects in numerous industries for time to come. I think the thing to think about, though, is that like we came out of the crisis in '08 via stimulus and government, via people doing what they had to do, you know, there's reasons to be optimistic, and those are that markets do self-regulate, they are efficient, In times of crisis, people rally around the cause. And more importantly, governments are taking some steps necessary to get us to where we need to be. So I think this one is going to be a little bit longer. I think we're going to be suffering a little bit more, but clearly, there ultimately will be a light at the end of the tunnel. And if the lessons of the Depression and the crash in the 20s and the crisis in '08 taught us anything, is that there's a resiliency among people to always get to a place that's better. So I think a good number of the people in the world are trying to do the same thing. And contextually, I mean, we need to remember that things are changing rapidly. I had thought about giving some quick indicators of kind of where the market was yesterday. As an example, the Dow Jones closed up, I think, a level historic to previous sessions. And I think crude closed at $18 a barrel. But if you look at what the futures are calling for the Dow this morning, and if you look at where oil ultimately closed out as of this morning, or is as of this morning, those numbers have already been shattered in the opposite direction. So that volatility is going to be there for some amount of time, and there's going to be some consistency to volatility if that's even possible. So I say that all to say, it's very easy to get caught up in the news cycle, whether you're watching Sky, BBC, CNN, CNBC, or Bloomberg. You're going to have that volatility, and where we may have an up day, we're going to have a down day. That's kind of the context of the world that we're sort of living in right now. So let's drill down into a little bit more mundane aspects of life, like commercial banking. So my background is originally in accounting. My first degree was in accounting, and my first job out of university when I graduated from University of Texas at Austin was with Pennzoil Company, a company that probably most of you have never heard of, but they were primarily involved in lubricants and motor oil, did some exploration. They were one of the larger independents back in the 80s. I graduated from the university in 1989, probably much before most of the students in class. In fact, I'm fairly confident I have shoes older than some of the students in your class, but we won't necessarily get into all of that. So I took that offer and I moved to Houston, sort of the oil mecca in the U.S., if you will, and worked as an internal auditor. Really enjoyed that job because I got to see the different business segments of a large multinational company. I moved into a financial role, which was basically counting the sulfur cars. Pennzoil was in the sulfur business, and so they would transport sulfur from the mine in Pecos to various distribution points. And so my job was to basically count sulfur cars. Well, I found out very quickly that that was not a lot of fun. So I decided to leave Pennzoil, and I realized that my strengths were in a different area. They were where I could interact with people, get out and about. I wasn't a person that could sit behind a desk very well, or at least not for a very, very, very extended period of time. What made sense to me, and was probably the best move I ever made, was banking. I actually started in what's called asset-based financing. And asset-based financing is what you call factoring. Factoring is where you buy, a company buys the outstanding receivables of a company and advances a certain amount against them and provides, working capital so that they can then go about their business. What happens in small business a lot is that the access to working capital to keep things moving can sometimes be delayed when payment gets delayed in your receivables. So what asset-based lenders do is they shorten that time period by buying the receivables at a discounted rate. They then charge a fee. It's basically like a revolving line of credit, but based on your receivables. So it's one of the most basic forms of finance out there. And I did that for a couple of years, really, really liked more than anything, not just and it's probably there where I learned to underwrite. Most classically trained commercial bankers go through a a banking program. It's usually a year long at that bank. They're disappearing. There's less and less of them these days. But it's in asset-based lending where I learned how to underwrite, where I learned how to determine ratios and how a company performs. So it was a very easy lateral at that point to move to a commercial bank. And when we talk about commercial banking, one of the clarifications you have to make is commercial banking is not investment banking. So commercial bankers don't trade. They're not making bets. They're not hedging the market, right? They're not doing private placements or anything like that. Commercial bankers are essentially financing small to medium sized to corporate businesses, and there are definite slices of the market. You typically have small business, right, which is anywhere from 0 to about 10 million in revenues. Then you have what might be classified as middle market, which is 10 million to anywhere from 50 to 100 million. And then above that, you've got what's called corporate banking. I've spent the majority of my time in small business and middle market. And that's a lot of your, in the United States anyway, it makes up about 99% of the businesses in the US. So, and they're the ones, quite frankly, that are being impacted the most during the current crisis, particularly because they don't have a strong enough balance sheet that is required. So during these times, liquidity, cash, or the availability to raise it in order to get to the other side of this particular crisis is very important. There was a statistic from the British Business Bank, the British Business Bank, that the members of the British Chamber of Commerce, 49% of those that responded said that they only have about 3 months worth of liquidity. So when you think about that, that's 90 days of survivability in the environment today. If you're a restaurant, if you are a small manufacturing facility, if you've only got 90 days worth of liquidity to operate, that's not going to probably get you through this. There's been any number of stimuluses that are in place now, both in the UK as well as in the US. I'm not going to go into too much detail on those. They can be kind of dry, but I think what we're seeing is that the governments are making an effort to try to help small business. We have to remember that if it represents 99% of the businesses in the US, as an example, it's pretty important to throw some resources at them. Getting into commercial banking wasn't particularly hard for me. I think what helped a lot was a background in accounting. Now, I have to say again, I don't really like accounting. I don't like it at all. I could have never been an auditor. I couldn't be a CPA or what's called a chartered accountant here because I just don't have the discipline to sit there long enough to do a spreadsheet, right? I mean, it's just, for me, it's just really challenging. But what I did realize quickly is that if I looked at financial statements, I could generally get a sense of what was happening rather quickly. And then I also found that I had a way of connecting with people. And at the end of the day, commercial banking is about relationships. Investment banking is about relationships. In general, that's what banking is about. It's about relationships. So I found that the ability to communicate and then understanding basic financial data was critical to having any amount of success in banking. Of course, as a banker, it's your job to grow either an existing portfolio or grow a portfolio from zero. And so that means adding new customers. And that's all about business development. And everybody has to do that in any sphere of banking, unless you're what's called a portfolio manager, who basically manages individual accounts for a relationship manager who's out there constantly trying to grow the business. So, we used to like to say in one of the banks I worked that you can never have enough business, because you're always looking for business. So you're constantly always marketing. And I think what you find is at different banks, there's different types of style, characteristic, or character, right? So whether you're working for, as an example, a JP Morgan, which is a white shoe type bank that has hundreds of years of of history behind it, or you're working more for a challenger bank like Amity Bank, which I worked for in Houston. You know, their character and what they're trying to do is usually different in the marketplace, and it's defined by their tolerance of risk and what they're willing to do. For me, I've worked at larger banks like JP Morgan. I've worked at much smaller banks, like, for instance, the Texas First Bank, which is defined as a community bank. And a community bank means a bank that has assets of less than $1 billion. The reality is even within that definition, that's the definition that the government set. The actual closer to average assets of a community bank are probably 100 million. So we're talking about really small banks that fit a particular need in the marketplace. They work in communities, and that's why they're called community banks. I think a lot similar to in the UK, the services that maybe credit unions offer, right? They're very geared towards a regional or local emphasis. In my career, and then also part as an investor, I had the opportunity to be part of a startup bank. When we went back to the U.S. after leaving the UK in 2010, you know, I was part of a founding group that started Houston Business Bank. It was unique because at that time we were the first startup bank that was granted a license in Texas after the crisis of '08. So there was a lot of uncertainty. You know, the business plan that had been drawn up by my partner was one that was hinging on a vibrant economy, not one that had just gone through a downturn. But the learnings, I think, being involved in a startup was immense. My actual involvement was as an investor. When we moved back to Houston, it became clear that we needed to do something different at the bank. We weren't necessarily getting all the traction that we were looking for. I opted to join the bank and take on the business development team, as you will. So, you know, it's funny how you get into things, right? In talking to my good friend, John, who was the founder, he said, you know, you can, and this is why the deal sounded so good to me. You know, he said, you can come in as many days as you want or as few days as you want. You can work from home, you know. I just need a little bit of help, you know, that's it. And, you know, for someone who kind of was in transition, coming back from the UK, I really wasn't sure I wanted to be a banker anymore. I thought, you know, I've done that long enough. Maybe this is it. But I thought, okay, maybe rolling into this in some sort of a part-time role makes more sense. Well, you know, I did that, and absolutely, true to form, that's exactly what it was. But as you well know, in any business, there's no, it's hard to remain in a part-time role when you're having to manage a function. So, in very short order, I was there, you know, every day of the week, and trying to grow bank. We had some success. I think what we tried to do was, more than anything else, is, and I've found this has worked anytime I've had an opportunity to manage a business development team, is we narrowed in on the 5 things that we did really well. See, the thing about commercial banking, community banking, anything related to business banking, is that there's really nothing new. Everybody has credit cards. Everybody can do line of credits. Everybody can manage your cash for you, right? So some of them may have a little bit different product, maybe a nuance to it that's unique to yours. But at the end of the day, you know, outside of what's going on in the fintech space, banking doesn't have a whole lot of innovation. In fact, what's happening in fintech is great because it's going to, I think, move banking further along down in terms of how they progress. But ultimately, the products have been this, you know, realistically the same for numerous years. So, you know, you figure out pretty quickly that you can't be all things to all people, right? And so at that point, what you need to do is figure out the 5 things, sort of the 80-20 rule, right? What's the 20% of your activity that gives you 80% of your production, right? The economist Pareto was really big about the 80-20 rule. And for us, it was 5 products 5 very simple products that we knew if we made an effort to sell those, to market those to the individuals and businesses that we thought would have need for them, that we'd have some success. So that was really good because it focused our efforts, right? Instead of trying to be all over the place, sort of a scattered approach and a more defined, direct approach. It helped us. It helped us tremendously. That and then managing the P&L side of the business got us to cash flow positive 6 months before our original projections. So we stuck in there and grew the bank to an asset size that we felt very comfortable with. One of our largest shareholders was another community bank in the Houston area, and on or about I want to say towards the end of the second year, the beginning of the third year of operation, we knew that to grow, and this is very common in community banking, right? So the only way to grow was either by acquisition or by bringing in some additional people that could bring books of business with them. And for those that aren't familiar, a book of business is a portfolio customer. So it's not uncommon for a banker to move to a different bank, and a vast majority of his or her customers will follow him. So like a lot of people say, it's not the bank, it's the banker, right? So you bank with the banker. And so that was our proposal, right? That was our idea, what we wanted to do. We took it to our shareholders, and unfortunately, one of our largest shareholders, the community bank, was not interested in proceeding with that particular plan. So one of our options then was to ask for a sale. So we did our valuation, they did a valuation. Ultimately, we came out with a number that worked, and in towards the latter part of 2012, we sold the bank, and it for everyone involved, it was a successful sale. We were comfortable with the premium that we exerted, and our largest shareholder, the community bank that we know very well, was happy because then that became their bank. They developed a foothold in Houston. And we went on to sort of do our things from there. So that was my involvement in a startup, expansion, and ultimate sale. I think one of the things, takeaway lessons from that, if you get involved in any kind of a deal, whether it's a bank or any kind of business, always make sure you own 100% of the voting rights in a business. So if there's anyone there that can exert control on those types of decisions, then you're gonna have a challenge really running the bank. So ensure yourself that as a founder, you never cede enough of the equity to where you're not in total control of the decisions. Otherwise, you effectively lose your company. For us, it worked out. I mean, everybody, I think, ended up in the right place. But it's a story that you hear a lot of times where founders come up with a great idea, they enact it, and within a year and a half, they're out because they've given up too much equity and lost control of their particular enterprise. So that's one of the things I think you need to concentrate in. And you don't negotiate that on the back end, you negotiate that on the front end. So many of these things are determined by how you negotiate on the front end. In banking, how you get out of a bad deal, a commercial loan, if it goes bad, it's more important how you got into it in the first place. So the covenants that you wrote out, right? Anything that could cause a default. So it's the paperwork on the front end, and a lot of times the homework associated with that seems a little bit heavy and too much, right? But the reality is that's when you really need to do your homework, because once something has gone sideways or the wrong direction, it's a little too late to make changes to the loan documents, if you know what I mean. You can't really do that. But after my experience there, I worked for one other community bank in Houston, and then ultimately lateraled over to microfinance, working for a small, actually a medium-sized microfinance entity, an MFE, that based in Houston, actually San Antonio with offices in Houston and 11 other states in the U.S. And they were primarily about making small loans to startups or existing businesses in the amounts of $0 up to $250,000, where the average loan amount actually was, I think, closer to about $18,000. So we're not talking about a lot of money. We're talking about financing, you know, someone's dream to open up a coffee shop or something. So that was that was a unique experience for me, and then I think I really wanted, because my time in banking had really been about working with reasonably larger companies, even though they were SMEs. But really at the microfinance level, what I found, something that I've always been interested in, Jacob, you know this very well, I've always enjoyed lecturing, guest lecturing when I get to do that. And I just found that entrepreneurs that are looking to start a micro business are typically more open to taking on someone as an advisor or a mentor. And I enjoy teaching. So that for me was an experience that gave me both the financial side of things in financing, as well as the ability to be sort of mentor and advisor. And I think that's where the interest in angel investing really started. I think that all of that sort of came about when I got a sense of just how undercapitalized micro and small businesses are. And there's some amazing ideas out there. I mean, I'm not looking to put money into a coffee shop, right? I mean, I don't see a lot of innovation there. But the reality is that there are people that are that are putting out any number of products, whether it's sustainable packaging or in healthcare, that start out in those spots. The thing you have to remember about microfinance, it's typically it's the granting of credit to individuals that can't get a bank loan. Now, there's a couple of reasons for that. One of the things since the crisis of 2008 is banks, due to the amount of regulatory oversight that they currently have, really can't make any money on a loan of $100,000 or less. It's really not feasible. If you think about the amount of people that have to be involved in touching a loan, they could charge 20% and they wouldn't make any money. And of course, they can't charge 20%. So there was a shortfall in the market, right? Community banks have a better ability to do that because their costs are a little bit lower in some areas like that, and they can do that. Microfinance, which primarily has been done very well in Europe, in Latin America, and in Africa, to basically start entrepreneurship, to promote entrepreneurship in areas where it doesn't exist, has now grown out of a sort of cottage industry into a larger sort of, let's call it industrialized. I mean, it's pretty institutionalized now. The firms that you see in the US are much larger. They still are not-for-profits, right? So they're still a charity, if you will. And they have to operate as a charity for the following reason. Even at operating as a charity, the vast majority are not profitable, because even they can't make a loan at less than $100,000 that makes money. So there's a social component, social enterprise aspect to what microfinance companies do, and they fill a need for entrepreneurs. There has to be some sort of a backstop in that area of financing, whether it's a government guarantee like the SBA does in the U.S., or here in the U.K., the British Business Bank has I believe it's called Startup UK. Startup UK is an excellent program. They'll do, I believe, a startup loan in several types of businesses. I want to say it's up to $25,000. Don't might be a little bit higher than that. I think the loan terms are something like 4 or 5 years. And then the interest rate is pretty much a market rate, right? Now, it's very uncommon for a commercial bank to be able to extend that at those terms. So what's going on there? Well, basically what's happening is the government is probably making some sort of an investment, guaranteeing the loan, or actually funding those loans. So what happens at those smaller loan amounts, you really need to have something like a microfinance enterprise that is a charity, if you will, or you have to have a government-sponsored program like the SBA or what the British Business Bank has here in the UK, which is a government-subsidized loan program to help small businesses. And if you think about what's happening right now, everybody who's on this call, I'm sure has a favorite coffee shop or a favorite small little restaurant in their enclave, wherever they live in London, like we all do. All of those restaurants, unless they're a chain restaurant, right, are effectively a one-man or one-woman operation. And those are the individuals that right now are feeling the most pain. Everybody's feeling pain, but those folks are feeling the most pain. So it's organizations like Lift Fund, Action, and the British Business Bank that can extend credit to those types of small businesses. And they will be the organizations that going forward will finance new businesses when this thing's all over. Because unfortunately, the fallout of a lot of this is we're going to lose a lot of small enterprises. But like I said earlier, I think the good news is that someone always has an idea or thinks they can do something better. And if they can market it, if they can commercialize it and monetize it, then that's something that deserves a marketplace. And you'll always have either individuals or certain types of funding options to make that happen. And I think you can segue that into what we're trying to do at Regent. So Regent started the Hive space there in the offices of the Career Center, I think about a year and a half ago, maybe 2 years ago. And essentially what the Hive is supposed to be is an incubator, if you will. Really, I think more a space where student entrepreneurs, either current students or alumni, can come and can interact, share ideas, but more important, have a workspace, free internet. So for some of our alumni, it's worked out quite well because they can come in, they can use the space. We've got some various students that are, well, I mean, they'd be in there now if they could, but they can't. The other thing to remember is that if our students, and a lot of our students come via this way, they're finished their undergraduate or maybe their master's program, and they have an idea, but their student visa is up. Well, of course, then they can, by sponsorship through the school, apply for a entrepreneurship visa or the innovation visa, and then sit through basically a panel to evaluate the viability of the business. And then the school would then sponsor the individual. I think the visas are, I think up to 2 years, they can be extended. So what the school is trying to do is to build out an ecosystem that inspires entrepreneurship. And let me tell you how this happened, Jacob. It was really interesting. So in talking to some of the folks that work and run the Hive, as an alumnus, I was looking for a place to plug in. And what we found out was that we've got numerous of entrepreneurs that are currently at Regents or have recently left Regents, that started businesses and gone on to do really well. But they were doing that all on their own, right? What the school wanted to do is to provide some type of assistance. Now, I think the ideas for the Hive are to be a true incubator, where we ultimately can offer, if you will, workshops to help aspiring entrepreneurs, or workshops that for you mentioned individuals in your class that might have an interest in opening up a business. Well, the first course offering that an incubator needs to have is one that tells students kind of the ins and outs of what it's like to be an entrepreneur, because maybe that's all you need to hear to say, yeah, you know what, I don't want to do that. And so those things are being built out. I think you're going to see a lot coming out of the Hive I would recommend and I would encourage the students that are on this call. They may already be familiar with it, but if they're not, once school is active again, I know they're doing some virtual workshops as well. But check it out, see what's there. And I think the most important thing that you can do as a student is to give feedback to the folks at the Hive, or even feel free to give it to me. I'm a third party. I have nothing to do with the school. I'm just an alumnus that happens to go in there, once a week, and I found a place to hang out. But without knowing what's needed, you really can't be effective. And I think that's what we're trying to do. So the idea that the new vice chancellor has of making the school about innovation, we can get that. We already got some a lot of work being done in and around the area of luxury brand management and fashion. So maybe that's what Regents becomes known for, but we'll have to see. So that, along with being involved with the Angel Investor Network here in London, and then with an investor network back in the U.S. in Houston. I have a partner. We evaluate a few opportunities. We were a lot more active in terms of evaluation, 2 months ago. Things have sort of slowed down a bit. But what I do with the investor networks, as an example, is they'll send me an email usually every other week or so on 10 or 11 different opportunities that are out there for investment. And as an example, I had a really interesting deal to look at, a company that was basically with algorithms using doing the accounting work and ultimately filing the tax return to the HMRC on behalf of sole proprietors. So neat bit of technology. The company did launch. They made their capital raise, and it's an interesting process, because what you do is you review information, you look at the existing financials, whatever's there, because if it's a startup, you're not going to have a lot of historical information. So as a banker, that's used to making decisions based on historical information, not on potential necessarily, it's a little bit different. But then there's the call with the founder. And talking to founders is interesting, because obviously you're talking to someone who's very optimistic about how the outcome is going to go in the product or business that they're looking to market. I truly enjoy conversations with founders, because I think I learn something new every time. So regardless of the outcome, those conversations are very interesting. And I think there's a set of characteristics, they've been published several times, that entrepreneurs have, and it's very unique to pretty much every founder that you will talk about. But I think the one that I always remember is every founder I've talked to is extremely confident. So that's if you're a confident person, that's one that you need. But Ember was one that I think was very interesting. Another one was a sustainable packaging company that had designed a new form of packaging using wool, which obviously is easier on the environment than, say, even cardboard or plastic. And those discussions went pretty well. We got pretty far down the line, and then the outbreak occurred. So that sort of slowed down. I think the thing about prior to that, my partner in the U.S. had called me about a CBD business, the acquisition of a storefront. We went through the financials. The deal looked really, really good. It was interesting, but ultimately that was one where him and I went two different directions. He went ahead and invested. I did not. And I didn't, not because it was necessarily CBD and I have a problem or an ethical issue with CBD. Typically my thought process is to evaluate the opportunity, evaluate the founder, look at the financial requirement, the notional, if you will, and then determine whether or not I can proceed. The other thing that you sometimes don't think about so much initially is the regulatory environment. And while CBD is legal in its current uses everywhere in the United States, it's by way of actually law on the part of the USDA, no regulatory oversight has been put in place. So I think and this is where it's a bad thing to have been a commercial banker, because you tend to err on the side of conservatism, right? And so for me, seeing that something as wide open as the CBD business, not having any real oversight just yet, it's just a matter of time. So so derivation of the CBD business is, so in marijuana, basically, you can derive the part of it, the bit that doesn't make you high, basically, and it can be used in essential oils. It can be used in all kinds of products. And the shops are popping up all over the place. We've got them here in the UK, and we've had them probably as long in the UK as we had them in the US. But the issue is there isn't any current oversight or regulation. And I think what I know quite well is that the government may be a little bit busy with other things right now, but it's just a matter of time before a certain amount of oversight comes into place, and then you really don't know how that's going to work. The other thing is, a lot of CBD businesses can't open up a bank account at certain banks because banks have taken the conservative approach that it's a business that they would rather not be in. So, the way I look at it, if there's going to be too many roadblocks, or if the roadblocks are some that seem a little bit too, if you've got to go around to get somewhere, then maybe it's not worthwhile. So anyway, he invested. Suffice to say, 3 months later, he's doing very well. Apparently, a lot of people are buying CBD products because they're at home, and some of it has the potential, I think, to relieve stress and make you feel sort of relaxed, if you will. But anyway, so we'll see which one of us made the right decision on that one. But right now, he looks like he made the right decision. Anyway, you have any questions?
Yeah, thank you so much. I think we have two questions here. One question from Nicola, which perhaps I put to you, and then one from Karim and one from me. Nicola is interested in your assessment with regards to small banks. Whether you think that those lenders are going to suffer more from non-performing loans during COVID crisis than the bigger banks, and that could potentially lead to another banking crisis, a small banking crisis in the US. Do you have any opinion on that?
Yeah, absolutely. It's a really good question. A lot of the recent information that we've seen coming out of the U.S. and it's and keep in mind, when I talk about a regulatory environment, it's typically after 2008. It pertains to most of the world. But one of the things that community banks fought was that they were susceptible to a lot of the regulatory oversight that much larger banks were. And so their argument was, look, we do absolutely no trading. We don't have any sort of investment side to our bank. We don't need to have the same capital requirements. Irregardless of that, they were held basically to the same thing. So the other thing you have to remember about community banks is they typically like real estate as collateral, regardless of whether the deal involves real estate or not, right? And ultimately, I think smaller banks, and by that I mean community banks with assets of $1 billion or less, have really been under assault in these last 10 years. So we've had a lot of fallout already in that sector. So you've had some consolidation. So I think that the community banks that are out there now have stronger balance sheets. And I think that's what the indicator is that we're getting from the trade associations back in the US. The TBA and the Independent Bankers Association of Texas is telling us that balance sheets are stronger and they've managed their liquidity well. So I feel fairly confident that they're going to do just as well as large banks, and they'll be there to make loans to our small business owners as we move through this.
Excellent. Thank you so much. I would like now to invite Karim, who's got one or two questions for you. Karim, please go ahead. Karim, you need to unmute. Perhaps I have to unmute him.
Oh, I think, yeah, that's right. I think you've got him muted.
Yeah, I think, let me just see here. Where's that here? Meeting settings. I think, no, he should be allowed to ask questions. Let me just see here what's happening here. I'm not quite sure why he is not. So if I can't, I'm not quite sure why he can't speak. He should be able to ask questions. Perhaps Karim sends me the question and I ask it. Karim, if you could send me the question, it would be lovely. Thank you. Yeah, Karim says he doesn't allow him to unmute. So if you could send me the question, Karim, that would be nice. Now I figure out in the meantime how to unmute. Not sure why this is the case. Sometimes too many questions, too many functions in Zoom that they put in now, and it makes it much more complicated now.
Yeah, I wasn't a big user, but I'm using it now.
Yeah. Okay. So we have here, I think we see. I ask you the question in a second. So we have here. So Karim, I'm waiting for Karim's question. In the meantime, I ask. There's another question. One from Karim here. Okay. Are there any opportunities you see at the moment with COVID-19 global pandemic that entrepreneurs can take advantage of? That's the best question, of course. Karim, well asked. So do you see any opportunities at the moment?
Yeah, I think you need to look at the businesses around those, and this is really a good question for just in general in the midst of a downturn. You need to look at the segments that seem to be doing well. So if you look at, so you can't even get into a Waitrose or Sainsbury's or Tesco. So that industry, right, has done. Healthcare is obviously moving quickly. The ability to logistically move things, right, from place to place. Even if you think about things like containers, how you get food to people. So, I mean, when someone asks that question, what do you see? What I always say is look at those things that seem to be still active. Right now, if you own a bookstore, right, in central London, and you don't have some ability to distribute online, you don't have a business, right? So that's probably not where you want to go. So the opportunities, because we don't know how long this is going to go, but for the smart entrepreneur, I think right now they're going to be looking at industry segments where there's some level of continuation throughout this entire pandemic and then afterward. So what you don't want to say is that Amazon's going to take over the world because they're the only ones that seem to be able to deliver anything. But I think you need to look at those industries that right now have been able to continue to function because they are a basic need. And then I think, this is a reality, folks. You need to bottom feed a little bit, right? And that's a term I don't know if you've heard or not, but you need to see those industries which were doing exceptionally well, those ideas that were doing exceptionally well that took a beating, because then there will be some opportunities. I think there'll be opportunities to partner with existing entrepreneurs, and once we get through this, is to launch. So just like the market, there will be an appropriate time to buy American Airlines. That time is not today. But Same thing goes for entrepreneurship. There will be a time to jump back into segments that weren't doing well, and then you'll see astronomical. You'll see what's called the snapback, and hopefully it's a V recovery as opposed to a U-shaped recovery.
Okay, thank you. I have another question here. This one from Stian, who's asking of your opinion with regards to commercial banks probably getting left out of opportunities as they're more risk adverse than venture capitalists. Your example of CBD being not attractive to commercial banks and real estate, but venture capitalists jumping on that.
Absolutely. And I would say, you know, we used to have a joke that banks aren't in the risk business, right? So, I mean, they're in the risk business insofar that they evaluate the risk of their credits. But banks aren't necessarily about financing startups. That's not what they do. That's why you have such a robust venture capital and private equity space. You have some banks that are large enough to have their own venture capital and private equity group, right? But it's usually off balance sheet somewhere else, doesn't have any impact on bank earnings. So at the end of the day, commercial banking is about collecting deposits, right? About helping businesses make payments, whether that's through online, whether that's wires, any way that you can send and collect money. And at some point, which is managing your cash flow, right? Treasury management, if you will. And then ultimately making loans, right? Commercial loans, well collateralized, well underwritten loans to businesses that are successful. So yeah, I think you might see them left out of a number of opportunities, but they're not. Remember, they don't have an equity stake. So the biggest difference between a commercial bank and a private equity or venture capital firm is they don't have an equity stake, right? They're just making money off the interest or the fees that they're garnering. So that's a big distinction.
So perhaps the last question that is a question that I would have for you is with regards to IRRs, you as an angel investor, have your IRR expectations changed in the last few weeks because of COVID-19, in that if you look at business and investment opportunities, you now want a higher IRR, or is that unchanged?
I think you have a threshold, right? And so what would you'd be asking for a higher IRR because of the conditions, right? But I don't know that any one business is going to eclipse your hurdle IRR that you set in this environment. I mean, quite frankly, if you look at the activity of most private equity funds and venture capital funds, they're kind of shoring up liquidity because they all know there's going to be a need. I don't know that right now is the best time, at least for me, to be investing. I'm watching. I'm still waiting. I don't think this thing is bottomed out. I think I'll return to I'm optimistic, but I don't think right now is the time to throw money at something unless unless it's something so unique that has a viability to succeed in the current environment going forward. And the biggest reason for that is because we just don't know how long this thing's going to go, right? And we don't really know what a post-COVID world is going to initially look like, and then even into the next year to year and a half, right? Because a lot of people are saying there's going to be a tremendous amount of limitation in the amount of activity that we can have. Whether schools will be meeting in person again, we don't really know that yet. So there's just a lot of uncertainty, right? I mean, I think the only people that seem to know what they want to do is the individuals that are short selling. They're shorting the S&P 500 right now. So those guys seem to know what they're doing. But if it was an idea, I'd have to be pretty far down the road, right? And so right now is not the time to talk to someone about proof of concept. I think it's hold on to your cash reserves, take the time to learn what's going on out there, learn lessons from the environment that we're in. And when we come out of this thing, there's going to be plenty of opportunities out there to take advantage of.
Thank you very much. A final last question here, again from Karim. I think that's an all-season question here. With regards to 2 or 3 things they would look at in a business plan that shows that a business is solid, it convinces you that you should you should invest.
Okay. So what are things that convince
2 or 3
me?
things that you look at when you look at a business
Well,
that show you the business is solid.
Right. I'll tell you what's very key to me. Number one is if and of course, a lot of times you're talking about businesses that don't have any historical financials, but I like to know, and I need to know that the founder understands his or her numbers. And what I mean by that is if you're selling a product, you need to be able to tell me how much it's costing you to source it, how much it's costing you to market it, what your margins are, and ultimately what your expectations are. That's number one. Number two is just the general demeanor, personality, and characteristics of the founder. If the founder seems like someone that you can work with, or who maybe has sharp elbows, but you can still work with, has that attitude, and you think can succeed, then I think that's important as well. Thirdly, who they're surrounding themselves with, right? Who their advisors or mentors are. I think that goes a long way. So if they've brought in some people that have some experience in, say, the logistics business, and they're doing something reasonably associated with logistics, they've done their homework. So those are the kinds of 3 things that I initially key in on. Remember, the product can be non-specific, right? At the end of the day, it's whether or not you think it is viable. There's a market. Can you meet the market? How much time do you really have to get this thing to market before somebody else does the same thing? So I would look at those other 3 things first. I don't really start thinking about the product until later on.
Thank you so much, Ed. I think that brings us to an end. I think there are no further questions. I would have lots of questions, but I think we need to bring it to an end.
Yeah.
We got 1 hour from you, very, very interesting, insightful comments. Obviously, you experienced initially as an accountant, then as a banker, and then as a commercial banker, then moving into your startup experience. I think it was extremely interesting to hear, obviously, what you got out of Regent, what you're giving back as a mentor, and I think that was very, very interesting to hear. And obviously, your experience now as an angel investor and the comments you made. I think it was very, very useful. Thank you very much, and I hope we stay in touch. I think it was very useful also to hear about what you said about the student hub, the hive, better to say, which it gives opportunities to students and alumni to actually test the ideas, to ask questions to people like you who are entrepreneurs, bankers, and so forth and so on. I think that was really useful, and I thank you. And I want to thank all of you who participated in the call. It's going to be recorded. It's going to be available, so we can actually watch it again. And those who couldn't participate,
Jacob,
was all very good.
I just wanted to say very quickly before people start popping off of the call is I don't want to give my details out because you're going to record it. But to any of the students out there that might have some additional questions or just want to talk about entrepreneurship or banking or anything that seemed interesting, please just ask Jacob, and he'll share my email with you. And I'm more than happy to entertain any additional questions. All right.
Lovely. Thank you so much.
Find me on LinkedIn, I think. Yeah.
That's very useful. So obviously LinkedIn, but we're also going to make sure that I'm going to put it out on Blackboard, so students will be able, if they want to ask you questions or contact you, they can contact you directly or via me. So it was excellent. Thank you so much.
Thank you,
to
Jacob.
all of you, Ed, and all the participants here, and also obviously my colleague Nicola, who is running the seminars for me. Thank you so much. Stay safe, and I hope to see you soon, either virtually or hopefully also in a more personal capacity very soon. So best of you, have a nice day, and thank you very much.
Thank you.
Thank you very much. Bye-bye.